The Barefoot Wealth Management Investment Model. Explained. We believe that the investment model that was widely used in the 1990s and still broadly used today could be improved. Traditional investment advisory strategies rely on portfolio diversification between cash, bonds, and stocks to limit risk and provide for growth of portfolios over time. We manage a different type of strategy. We believe that there are three main risks that determine if your account will gain or lose value. They are asset allocation risk. This risk is an indicator that you are in the wrong asset category. That is, you may be in stocks when they are performing poorly, while another asset category like real estate or gold is performing very well. Investment selection risk. This risk is an indicator that you made the wrong investment. You may be in the right asset category, but you invested in the wrong security within that category. This would be the case where energy stocks as an asset class are doing well, but you invested in Enron when you should have invested in Chevron. Timing risk. This risk is associated with when you enter or exit the asset class and the security selection. You may have been correct in your assessment of the asset allocation, and you may even have picked a good security to invest in. But the timing of that investment was poor, and you bought at a time when the market was overpriced. Many advisors and money managers would have you believe that the most important decision impacting your portfolio is the investment selection, and that they can deliver superior results over the long run by picking the better investments. They maintain that a buy and hold position is helpful, and that a proper portfolio of stocks and bonds represents the safest long-term portfolio for avoiding risk. They see the asset allocation risk and the timing risk as playing minor roles. They promote stocks and equity-style mutual funds, and argue that over time you should stay in the market because if there is a loss, the market will always come back. We have a different strategy. We believe history has shown that bear markets in stocks or any asset category can take many years to recover. Multiple objective studies determined that anywhere between 69% and 80% of investors' total return is determined by the asset allocation decision. That is, being in the right asset class and staying away from the wrong asset class is the most important part of the decision process. Your portfolio's returns and risks will depend on identifying the long-term bull market trends in various asset categories and investing where that winning trend is going. Conversely, investors must be very careful to avoid asset classes that are in a long-term bear market. It does no good to pick the best security in the worst investment class. In graphic terms, a great stock in a sinking ship will tend to go down because its asset class itself is performing poorly. We acknowledge that the timing of when a position is purchased and the specific security selection does add some value and risk protection, but we do not believe it adds anywhere near as much as the asset allocation decision. If the asset allocation decision is the most important decision, we believe that it is where the investor should focus. We fundamentally reject the idea that asset selection risk is unpredictable and cannot be well managed. We think it can be. Yes, it is true that the short-term daily or weekly trends can't be identified with precision. However, the longer the trend and the more powerful the bull market forces that drive it, the easier it is to identify and stay with the trends. We do not think risk is controlled by spreading your assets across 10 to 12 asset categories. In fact, we think it is entirely the opposite. If we can identify the strongest trends and determine which assets are the strongest in the market, Why would we not concentrate our positions in 5 or 6 of the strongest asset classes? We want you to avoid risk by being in the right place at the right time. It is true that all asset classes are subject to extreme fluctuation from time to time. In the market meltdown of 2008, for example, gold and stocks both collapsed in October of that year. Stocks, as measured by the S&P 500, bottomed out 5 months later in March of 2009. They did not recover from their loss for 2 years. Gold, which was the strongest asset class going into the 2008 collapse, bottomed in October, fully recovered in 4 months, and made a new high in 5 months. The lesson is, the stronger the asset class, the faster the recovery is likely to occur. This is why you want to be concentrated in the strongest asset classes. The Barefoot Wealth Management investment process. To show you how we approach this, we start with 2 questions. First, where are we in the long-term investment cycle? In other words, is the long-term trend favoring hard, tangible, and real assets, like precious metals, commodities, and real estate? Or is it favoring financial assets, like growth stocks, corporate bonds, or high-dividend stocks? The second question is, what specific asset categories within that long-term trend should we be in? So let's get started on the first question. We want to identify the long-term investment cycle, and to do this, we begin with one very crucial measurement, the Dow to gold ratio. The Dow to gold ratio tells how many ounces of gold it takes to buy 1 unit of the Dow Jones Industrial Average Stock Index. When the ratio rises above 9.0, meaning it takes 9.0 ounces or more of gold to buy 1 unit of the Dow, then the ratio is favorable to gold because stocks are expensive relative to gold and gold is cheap relative to stocks. When this condition exists, the long-term bull market is going to favor hard and tangible assets, not financial assets. When the ratio is 2.5 or below, meaning the value of gold is so high that it only takes 2.5 ounces of it to buy 1 unit of the Dow, stocks are a better, less expensive value than gold. The long trend will favor financial instruments, not tangible or real assets. When the ratio is between 2.5 and 9.5, the trend is said to be neutral, and neither tangible assets nor financial assets are preferred over the other. A big word of caution. Now a word of caution is due here, and it is crucial in understanding when the ratio is actually used to trigger investment purchases. The ratio can cross over or under these thresholds for many months or even years before the actual investments will start to move. For example, the ratio passed over the 9.0 to 1 mark in 1993. 8 long years before the price of gold actually began its bull market performance. Barefoot Wealth Management, based on our own research and that of Edward Nardesian, uses a customized formula to know when a long-term trend is ready to be entered and when it should be exited. If the Dow to gold ratio is favorable to gold, it will generally follow that there will be a long-term bull trend in things like oil and energy, commodities, materials, and natural resources. It's almost impossible to think of gold and silver going up 200% while energy and materials prices fall. This has not only been a theory, it has been the actual case for the last decade. If the Dow to gold ratio is favorable to the Dow, it generally follows that you want to be out of tangibles